Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and these are big days indeed. We've just seen the release of US inflation data. The headline was a wonderful fillip to the equity market, which rallied initially, as did bonds, and the broad general market response was favorable to that US inflation data, especially as the through-year headline rate dropped to 5%. And of course, the monthly data headline dropped from 0.4 to 0.1%, which was weaker than I'd expected. But here is where it gets very, very interesting indeed, which is why I personally enjoyed selling that rally in the equity market last night, as well as the bond market. All of the good news based on the false and misguided belief that the Fed will at some point be cutting rates is pretty much priced in now, and the Fed won't be doing that. And the idea that you buy stocks because the Fed will stop hiking interest rates and earnings will collapse, that just makes no sense at all. So the market is caught very long equities here. And the market had also been selling the US dollar. And in a big picture sense, historically, I am extremely bearish the US dollar, though I think the market is caught short here and we could see a rebound in the US dollar, which means euro and Australian dollar weakness. And the fact is, if you're bearish the US dollar, there are other currencies in the world to sell it against that are preferable to the euro, where there is still a war, and to the Australian dollar, where that economy, our economy here in Australia, is highly vulnerable to a slowing global economy, which is something that is definitely happening and should, hopefully there won't be, and I do not expect there will be, any military clash between the US and China. The Australian dollar would sink very far, very quickly. So these are not good currencies to be playing the end of the US dollar game against. So therefore, I think they are currencies that could fall reasonably quickly if, as I suspect, the whole global market is at this point caught short US dollars too early, if you like, in terms of the big picture fundamental processes at work there. There is no doubt the US economy is in trouble. Now, what was interesting in the inflation data is, of course, that the through-year core inflation data actually did reaccelerate to 5.6%, which is a horrific number for the Federal Reserve. And at the same time, the Federal Reserve seems to be comfortable with raising interest rates, even if there is a banking crisis simmering in the background. And I do expect that banking crisis to reemerge. I mean, a lot of people want to be very hopeful about that, but the fact is that depositors are still withdrawing significant funds from the US banking system as we speak. And if, as I suspect, and I have shorted the bond market, the 10-year, yields continue to move higher now, not necessarily because of any fundamentals, but just because a lot of investors around the world wish to exit that market. So less to do with what the Fed is doing, less to do with the US economy, just a desire to exit the US Treasury market when there is even risk of default. Probably won't happen, but it is a risk in the discussions over the debt ceilings. And you have falling property markets. There is a lot of talk in the US now about the potential for a commercial property market collapse even, akin to the GFC, but on the commercial side. And so these are all worrying signs. And we know property prices in the US are declining, as we forecast they would in advance of that turnaround in the last 12 months. And we know that equity markets have declined significantly and are precarious. Stock market valuations are based on this false premise that the Federal Reserve will be cutting interest rates by 75, 100 points over the next year. It's just not going to happen. They may raise interest rates by 75 to 100 points if inflation rekindles. So again, I come back to that inflation data just released, which showed very clearly indeed that none of the latest move higher in gasoline and natural gas prices have factored into that data release. In fact, in that month's data release, where the headline fell from 0.4 to 0.1, we actually saw declines, significant declines in gasoline and natural gas prices contributing to that decline in the headline CPI data. But since then, gasoline prices and natural gas prices are already much higher. So even if they simply stay where they are now, if energy prices in the US, domestic energy prices in the US were to stabilize through the rest of the month, even then that would re-accelerate not only the core number, but also the headline number in next month's release. What I actually think is going to happen is that energy prices in the United States are going to be still yet higher as the month progresses. So that means a significant upward input on that headline inflation number. It was good to see that shelter price pressures moderated in the US over the previous month, but it was really this turnaround in energy prices that I was looking for the re-acceleration in the headline, not quite seen, but we did get it in the core number. And I think in next month's inflation release, you will see that re-acceleration across the CPI data curve. So this is by no means a reason to be buying equities, thinking the Fed will stop. Of course, they're not going to stop. Core inflation went up. Energy prices are on the move higher. The labor market is tight. Inflation is stabilizing or moving higher again overall in coming months. This is not a situation where the Federal Reserve will be cutting interest rates. It's not going to happen, even as the US economy slows. So we're still in, despite all the fantasy economic forecasting out there, the reality is that the United States is still in the grips of a slowing economic environment, high inflation, actually extreme inflation, even at these levels, and a Federal Reserve that has said it will hike interest rates even if it hurts the economy. There is no room in any of that for some of the fantasy scenarios some people are proffering. So the outlook is dire for the US property market. The outlook is dire for US equity valuations because earnings are definitely on the way down in big margins, which is why large corporations across the United States and across sectors are laying off staff. And we already know the building industry is in recession. Manufacturing is in recession. Retail sales have been lackluster, to say the least. Consumer confidence is at GFC levels. The only piece of data that's strong is the employment data, but that doesn't take into account that 2.6 million workers did not return from pre-COVID to post-COVID. That's why the employment data looks strong. So it isn't actually as strong an employment situation as a lot of people would like to think. What does this mean? This means we probably just saw the top in US equities for the time being, because everything the bulls could hope for, they kind of got. And yet still the market closed towards its lows in New York and is looking soft in Asia. I think we just saw a significant high in US equities, and it's certainly a wonderful risk-reward opportunity if you feel or agree that equities are going lower and you feel you should be shorting the market. You've got a clear stop loss level above those inflation release highs. So you know where you will be wrong. I know where I will be wrong. This creates a good risk reward opportunity if you're just so inclined and that's what you feel you should be doing. Overall, for everyone, I continue to strongly recommend playing defense with your investment portfolio and do not get caught up in all of this nonsense about the Fed cutting rates. The people who are forecasting the Fed will cut rates have got it wrong all the way through the last 18 months. Completely wrong. They thought inflation would peak at 4% before it went well above 8 and 9%. They thought the Fed would be pivoting in the middle of last year. And here we are approaching the middle of this year, and they're still hoping that sometime, pushing it further and further out all the time, the Fed will cut rates. They're missing the big picture development. You know, it's like the frog in the slowly heating water. They're missing the big picture. People aren't standing back enough. Stand back. Look at a long-term interest rate chart. It's still too low. Interest rates are still stimulatory by historical standards. That means in some perceptions, US interest rates aren't even neutral yet. So of course the Fed will continue to hike rates. The outlook is not good for the US economy, therefore US corporate earnings, therefore US equity markets. I hope this helps you. All the best. Clifford Bennett, Chief Economist, ACY Securities.